Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey, welcome back to ETF Spotlight. I'm Daniel Snyder, and today we are joined once again by Rob Isbitts. You might know him from Sun Garden Investment Publishing here on Seeking Alpha or the world of ETFs because he is the man that has been ingrained in it so long. But today we're going deeper. We're going macro. We're going into sectors. We're looking at all of them to see what he is seeing in the market right now from what the price is telling us. So Rob, thank you again for jumping on the program. Wanted to see if we could just kick things off with, obviously markets have dropped significantly since about mid-February. What are you seeing with this correction, or is this just a moment in time? Should investors be worried? What are your thoughts?
Yeah, great to be with you again. And let me tell you, I think there's a lot of stuff that says we used to say is kind of coming home to roost. Okay, my whole approach to investing is based on the idea that everybody knows how to play offense. Not that many people know how to play defense because they are not taught. And ever since the pandemic, we've had this sort of deceptively easy ride. And that doesn't make me a bull or a bear, I'm just a realist. But I think that understanding markets as it's not just what should I buy now, it should be how can I defend while I'm also trying to grow my wealth. Otherwise, you may end up going years, as people did earlier this century, where you kind of net out to nothing. And part of that is the way the S&P 500 is structured and has been for a while, because tech has run away with everything and it's created a fairly deceptive market, so that even now when you get pretty rough performance for tech and the Mag 7, but you also get, let's say, some green shoots, if you will, from the smaller parts of the S&P 500 sector-wise, it almost gets lost because everybody's so focused on the broad index and on the NASDAQ and where can I make money now?
You have a very strong point there, right? You all we've ever been told for the majority of investors is just invest in the S&P 500, right? Put the money there, do it whether it's through your retirement or your individual portfolio. Yep. And ride the wave. And it's typically worked out based off of the rebalancing approach of market capitalization. Now we're in a period of time, as you had mentioned, the Mag 7 at the top, that have been dominating the index, but rightfully so, because their earnings continue to grow, right? So why is it that if earnings continue to grow, that investors are now getting shaky in their boots here and saying, well, maybe tech's not the place I want to be?
They're all in sync, okay? The numbers are too high no matter where you look. Does that mean they can't continue? No, because a year ago, 2 years ago, they were a little bit high. Now they're historically high, whether you're talking about PE ratio, smooth PE ratio, price to sales, and you're starting to see all of a sudden maybe a crest in the other thing that matters, which is liquidity. I can at least say that the odds are moving toward the next, let's call it big return, 10% up, 10% down, 20% up, 20% down. They're getting more decidedly toward down, not up. And that's really the beginning of it for me. So yeah, I mean, it's great that the numbers are great, but the prices of stocks more than reflect that in almost every sector.
Now, what about the people that say, you want to buy low, sell high, but there's also the people in the momentum camp that say, well, I buy high and I'll sell higher. So what is it about the momentum trade that might be broken right now that people need to know about?
I guess to put it in very sort of layman's terms, this market's been driving over the speed limit probably, in the 80s, okay? And I don't know too many 85 mile an hour speed limits, not around here, maybe the Autobahn or something, but it's now starting to crest, if you will, and it's either going to be, the old pause that refreshes, or I think more likely, I would say probably if I were going to put a number on it, 3-1 in favor of, the next move of significance across most sectors being down. And look, I mean, this is not new to me. I'm not reacting to this so much because when I did what a lot of analysts did on Seeking Alpha in December, and I put out my forecast for the year. I'm not much into forecast, but my best guess was, that the S&P 500 could settle this year end around 4,800. That was very much in minority. And I have no idea if I'm going to be right. It doesn't affect my portfolio positioning, but it does make me very well aware that defense goes with the offense, because when you can play offense and defense at the same time, it's much more a matter of expressing investing. And this is all the way at the sector levels as well as at the broad market level. Okay, how invested am I? It's a matter of degree, not a binary choice. And I think a lot of investors right now, they think of every decision as binary, and that is a habit I would encourage them to break and break quickly.
So offense, defense sounds a little bit like a barbell approach that you're taking here with this specific viewpoint. But let's talk about sectors, right? Let's talk
Yeah.
about what you're seeing on the charts. Let's see, what sectors
Mhm.
right now look attractive to you in this market environment, and what is that telling you?
Energy looked the best, but the best of a bad bunch. And I'm just looking here. I mean, since the market peaked on February 19th, the exact same day that it peaked in 2020, by the way. Pandemic versus whatever we have today, but there are more similarities than people, I think, give it credit for, except that it's not a pandemic, but the emotional factor. So, anyway, energy is the only sector that's up since that time. But I think what's more interesting is that these smaller sectors, okay, there are 5 sectors in the S&P that make up all of 16%. The other 6 sectors make up 84%. That's your tech, et cetera. And they've kind of pulled up the market averages. I think, relatively speaking, and this is relative because right now, none of them look great to me, but those smaller sectors in particular, it's funny, I just wrote about Pfizer, and I'm not talking about Pfizer here, but it is the P and the F and the E. Okay, just like the Pfizer symbol. Those are the 3, let's say, relatively look best. XLP is consumer staples. XLF is financials, although I question that one. Even myself. Again, I think it's a very skittish market. And then the third one is energy, which still looks like a relative outperformer. But a lot of this is going to have to do with interest rates. And to me, the one other thing that people should keep in mind, look, it's been very anti-tech for a while. I think people are dramatically underestimating just how cheap something can get when they're looking to buy the dip.
I would like to go back a second, double click on you had mentioned financials and how you don't feel like that one, even though your data is showing you that financials is still kind of in this group, right? Why do you feel as an investor yourself that financials are not going to be able to navigate this environment, especially with the market pricing in the next Fed cut potentially being in June?
Yeah, it sounds cliche, but that's a really good question to follow up. The thing about financials to me, I look at everything as ABL, avoid big loss. So the very first thing I want to do is I want to manage risk. And then, you go from a philosophy to a process all the way down to your tactics, but risk management underlines it all. And when I look at any investment, so let's take these sectors, okay? If I were to say, all right, which ones would I own if I had to own 3 or 4? Okay, I guess financials would be in there if I had to own some of them. Now, keep in mind, that's not going to move the S&P much because most of these sectors are small. Financials is bigger, but the issue with financials is the following, Daniel. We all remember 2008, and we also remember 2007. And one of the things that was common to probably the last 4 or 5 market declines, if that's what this is, one of magnitude, not just a correction. The thing about the financial sector is, they're on the hook for a lot of stuff. There's been a lot of margin, a lot of leverage, a lot of speculation. And to me, I always get, the heebie-jeebies about financials. Not my favorite sector by far, okay? And it's because there is that blow-up risk that maybe doesn't exist the same way in a Staples and utilities, which are regulated companies. Even in tech, because as you said, the earnings and the balance sheets for a lot of the bigger companies are rock solid. The problem is the prices have just gone in the stratosphere. And I guess the other thing would be, and this ties in financials and tech. Financials kind of the big value sector, tech the big growth sector.
I'd love to wrap things up here by asking you about, we've covered a lot of the different sectors and we look at the ETFs, right, that track them. But specifically, we think about what the administration is trying to do here, right? They tell us that they want to bring money back to America. They want to reinvest in America. They want to build out America for the next stage. So what's the story with industrials? Where is it a constant, like, just waiting for the bottom and don't catch the falling knife? Or what's your take on the industrial sector?
If you're in a chair and it's about to, fall over and you catch yourself, but then you kind of lose track of what you're doing and you fall over on the ground anyway, that's what a lot of this market looks like. And I think maybe we'll include a chart on the XLI for this. But the best thing I can say about XLI and why it is different from all the other sectors to me, and why it is one of my favorite sectors, pound for pound, is one of the first places I look for value at the stock level, is the way it's structured, okay? The way the weightings are. If you look at the other 11 sectors, the other 10 sectors of the 11 in the S&P 500, they're all heavily weighted, okay? Tech is 3 companies, Apple, Microsoft, NVIDIA is like, 40-something% of it or 30-something%. It's a lot. And they're all like that, except for industrials. And I think this is just because they've never had sort of like this major boom over the last decade. They've been a little steadier. And as a result, you've got a bunch of stocks in the XLI that are roughly the same market cap. And that's what all these things are based on, at least the popular ones. So because of that, I guess I would call it more like a mile wide and an inch deep. You got more companies to choose from. So the sector may see the winners and the losers even out a bit in this environment, but my guess is that over time, there will be some pretty good winners that will come from there. And I thought this about a year ago when I first started running Sun Garden Yark portfolio, when it was a portfolio before it was an investing group here. And the industrials were heavily populating the portfolio, but it didn't last that long. And so my exposure is fairly low now, but I think it will happen again. So I think it's a great sector to focus on for the long-term investor waiting for the prices to come to them.
All right, Rob, let's go ahead and leave it there. I really appreciate the look through the sectors here today. Everyone, can't encourage you enough. Go follow Rob here on Seeking Alpha. He's constantly putting out a wealth of knowledge and research, as well as check out his investing group here on Seeking Alpha as well. And Rob, we'll see you here again, hopefully soon in a few episodes. And everyone, we'll see you in the next one.